Welcome back to the channel. Today, we are diving into the mechanics of credit risk, specifically focusing on hazard rates and recovery rates. To understand the risk of a bond defaulting, we first look at the hazard rate, which represents the probability of default over a very short time interval, assuming the issuer has survived until that point. This is also known as default intensity. When we look at these risks over a timeline, we distinguish between unconditional and conditional default probabilities. The unconditional default probability is the marginal probability of default in a specific year as seen from today. For example, if a BB-rated bond has a 4.99% chance of defaulting by year 4 and a 3.46% chance by year 3, the unconditional probability for year 4 is 1.53%. On the other hand, the conditional default probability is the likelihood of defaulting in year 4 given that the bond survived the first 3 years. In this case, you would divide that 1.53% by the 96.54% survival rate to get a conditional probability of 1.58%. If we consider a short enough time frame, this conditional probability is essentially the hazard rate. To calculate the total probability of default by a specific time t, we use the given formula. If we assume a constant hazard rate of 2% per year, the probability of default by the end of year 1 is 1.98%. By the end of year 5, that cumulative probability grows to 9.52%. Moving from the probability of default to what happens after a default occurs, we look at recovery rates. The recovery rate is the portion of the bond's face value that creditors receive, often measured by the trading price about a month after the default. Recovery is heavily dependent on seniority. Data from 1983 to 2021 shows that First Lien bonds have the highest average recovery at 54.6%. While Junior Subordinated bonds fall to 22.3%. It is vital to remember that recovery rates are negatively correlated with default rates. In a weak economy, default rates rise while recovery rates fall because there are more foreclosures and assets for sale, driving down market prices. This creates a double-edged sword for lenders. They face a higher frequency of defaults and a lower amount of money recovered on each one.